So they've always been trading the precious metals or expanding into different forms of energy and other commodities, and they're becoming a little bit of a powerhouse, I think. One thing I've noticed with regards to precious metals market is they're more heavily physically traded. So whereas on the COMEX or the London markets, there's a portion of the contracts or the trades that will eventually settle in a physical position, it's really a small percentage. And that those markets weren't really designed with the intent to be physical delivery markets in the beginning. I think this is something that Craig Hemke and TF Metals points out all the time, and my research indicates the same. The derivatives markets really originally were for hedging and have turned into mostly a speculative market. However, I do believe as the precious metals have been harder to come by, and they are, that people have been moving over to derivative markets to take delivery. And I think a lot of that was originally industrial demand, but I also suspect that some of it is now investment demand, now that we're looking at what's going on in the world and what looks like a potential deflationary environment coming, and potential deflationary spiral. And so I think people are using all of the markets more for delivery. But in the Shanghai market, they have a much higher percentage of contracts delivered. It's up in the 70% range for gold, and silver is pretty high there as well. And so there's a lot more physical deliveries. Yeah, I think the latest report from the Shanghai market, I guess, in gold at 69.7% delivery, and silver almost 17%. That's actually down a little bit from previous months. It was a little bit higher. And you can see the yearly cumulative total ratio down there is a little bit higher, 72. In silver specifically, though, the average for the year has been about 10%. The last couple of months, it's been either 16, I've seen as high as 20%. So there's definitely more of the trade in China on the silver market is being physically delivered. Even though it's a heavier physical market to begin with, it's become more heavy. And there are probably a few things we could take away from that. We could take away the fact that people know that it's a physical delivery market, and if they need to get physical delivery, they're going to go there. Because on COMEX, not everything has to physically settle. You could settle for cash, the contract could be rolled. And my understanding is both the exchange and the trading partners on COMEX have the ability to negotiate that out. So there's no guarantee that if you stand for delivery, you get it. There are different cases or reasons why that may not occur. But Shanghai has always been one that it's easier to get that physical delivery. It's more of that physical delivery market. And that's probably because it's not considered the market that determines spot price. And so therefore the players are there maybe less for the speculative trade and maybe more for physical delivery. And so you see those amping up and you see people going over there. And I think when you look at that combined with the fact that we've had in silver specifically, a lot of silver ounces run off of the COMEX and London. They're no longer, and we're not talking about just taken out of in COMEX, taken out of registered and eligible private storage. I mean, we're talking about taking off of the exchanges and the depositories. It almost seems as though either the metal is moving west to east and it's going through the Shanghai markets, or perhaps people just need so much of it, they're draining it everywhere they can get it. So either the metal's flying west to east, or the metal's just being literally absorbed by the world market, which is probably more the case. And it's just another indication, Chris, that silver supplies are getting really tight. And we don't know where all the silver sits. Of course, there are private contracts and private held, reserves of the precious metals, and from people that have been wise over time and knew that we would get to a point where they would become more valuable. So there could be some additional ounces out there that filter into the market. Certainly, we've seen some selling on COMEX as silver's reached 23. I think there's 4 or 5 million ounces that got sold back into the COMEX over the last few weeks, given that price rise in silver. But it's a drop in the bucket according to what has run off since silver squeeze of last year. So that kind of tells me from a price sensitivity perspective, we could go $25, $30 silver, and yes, some people will dump silver, but you're not going to dump enough to meet the demand. And what is the demand, or the net demand would be 194 million ounces. If you look at the Silver Institute for this year, they revised. Originally, they thought it was going to be 116 million ounces short this year. In their November interim market report, they said 194. So it's 194 million ounces that the market wants that the miners can't produce this year. And I think you see that number by Silver Institute, and you see the numbers of the ounces coming off of the exchanges, including now Shanghai. And it's pretty easy to see where we're headed for a deficit. And it's pretty easy to see why. The world needs silver. And so even if people had some stockpiles of 100 million ounces, even if they dump that in the market, I don't think it's going to move the needle very much on price. I think silver is incredibly price elastic. because of the way that it's used, and I think the price can march as high as people need it to resolve those shortages. And I think that's what we're looking at. We're looking at the shortage stage now, and then when the market realizes it, when they can't get the silver, I think is when you're going to have where you see the price kind of go nuts at some point, and people are going to bid that up as high as it needs to go. Because if you need to build your satellite, or you need to build your electric vehicle, or you need to build your medical implement, or you need to build your iPhone, and silver is a half an ounce in each one of those, if you pay 4 times the amount, you're going to do it because you need it. But multiply that over billions of times from billions of different products in the economy, and that's where you can sustain substantially higher silver prices. And silver being such a small market, it can get bid up very quickly when people need silver, when money flows into that space. Then we're not talking about the gold market, which is much bigger, or even like the bond or stock markets, which are huge, or real estate market, which is huge. Silver is a really tiny market. So any additional amount of demand certainly could send that market price spiraling upward.